UK corporation. A UK company has a 100% subsidiary in India. 100% subsidiary in India lost its whole capital. So the poor fellows could not go to the bank and ask for a big borrowers scheme when they could not take any loan. So they requested the parent, our existence is only dependent upon if you contribute us some interest-free loan. And therefore parents were a little merciful. So they subscribed, they sent without any interest advance, of course necessary approvals, etc. Interest-free loan was granted, huge amount, to the Indian subsidiary. Question arose, assessment of foreign company is done by International Taxation. Assessment of the Indian company is done by the domestic wing. The case is referred to the transfer pricing section because Indian company was not paying interest. Indian officer was not bothered to make a reference and addition on account of transfer pricing. So he says happy. Indian company is not paying interest, very good. Foreign company's assessment when it was made, the officer detected, oh, there is a transaction of interest-free loan, which is an international transaction, and it must be subject to transfer pricing. Transfer pricing officer, it was referred to, and he said, interest-free loan, how can you give? Under the principles of arm's length price, you must charge some interest. So interest was imputed in that company's case. It was mind well, please note, this was a foreign company, and interest was attributed and an addition was made on account of that interest receivable from an Indian company. And that matter went up to CIT appeal, they lost. They went to appeal in the tribunal and they lost in the tribunal. Please note, interest-free advance is a crime. You have given interest-free advance to the Indian company, you ought to have charged interest. Having not charged interest, transfer pricing officer has justified in making an arm's length interest charge in your books and in your hands, and therefore an assessment has been made correctly. Unfortunately, if this situation after the secondary adjustment comes in, can you make a secondary adjustment also in the hands of the foreign company in India? Oh, you ought to have charged interest, you are not charged, so adjustment is made. Therefore, secondary adjustment also should be made. Indian company is insolvent virtually. They cannot pay you money. How do you expect them to pay money? They are waiting to be served. They are surviving only on the basis of your fund received from the foreign parent. And therefore, assuming and making secondary adjustment in such a situation is really, really draconian. Now the issue arises, if an Indian company in a similar situation had a subsidiary which had suffered huge losses, contributes interest-free loan to the subsidiary company, would you take it as a free of interest and arm's length price should have been charged by the holding company to the subsidiary company? Answer is no. Under which provisions you are supposed to charge interest? There is no provision, and therefore, if the interest is not chargeable in the domestic arena, how do you expect foreign companies to be governed by these provisions of the interest charging and arm's length price of secondary adjustment? Therefore, in two similarly situated companies in a similar circumstances are being treated differently is nothing but a discrimination. And this discrimination under the tax treaties, wherever non-discrimination article exists under the treaty, there are some treaties which we have come across where there is no non-discrimination article. For example, you look at Oman treaty, there is no non-discrimination, a number of them. There, what will be the situation is different because that will be governed by domestic law. But where the treaties have a non-discrimination article, it's a clear and befitting case to take up the matter for non-discrimination under the treaty, and that can be challenged on the subject by itself. And you have a famous decision of Pune Tribunal in the case of Daimler-Chrysler, where two similarly situated companies, the German listed company's subsidiary in India, which has suffered losses, and that loss was not allowed to be carried forward by the income tax department because it was sold to another group company within the group. And in that case, they says condition under section 79 is violated, and therefore we will not allow you to carry forward the loss. An argument was made before the tribunal saying that had it been a subsidiary of an Indian company, telco, similar circumstances, you say manufacturing automobile, telco is also manufacturing automobile. Automobile company which is listed in India, is a subsidiary in India, suffers a loss. Whether section 79 will apply? If you look at section 218, the widely held company's definition, the widely held company definition includes a subsidiary or a company in which 40% investment is made by a listed company. And therefore, such company's loss is allowed to be carried forward. And if you can do that, how can you discriminate a German company? And therefore, it is a clear case of discrimination, and the matter was decided by the tribunal in favor of the taxpayer. So therefore, we go to the next item. One issue is the associated enterprise definition. When we look at it, says the three conditions. We have the definition, just look at that. Section 92A1. If you look at the definition of section 92A1, they say a company which participates directly or indirectly through one or more intermediaries in the management, please mark these words, very important, management or control or capital of the other enterprise. So these three conditions must be fulfilled. Your companies, two companies must be under the common management or under the common capital control or under the common control. Then only the companies can be associated enterprise. Under basic condition under section 92A1 and subsection B of section 92A says, for the purpose of section 92A, following will be deemed to be associated enterprise. And therefore, the tribunal in the case of Orchid Pharma, again Chennai tribunal very recently did the decision, 31st January. What the decision they have taken? If you say, I have sold goods, I gave this example earlier, I sold the goods to another company, a foreign company, my total sales to that foreign enterprise is only 5%. Section 92AB does not have any percentage of sales to regard as an associated enterprise. And therefore, officer took a view, even 1% sale to an enterprise where the price is fixed by the other party, then it is associated enterprise. Matter went up to the tribunal and tribunal said, hey, look at, we will see whether it is an associated enterprise or not. These are the examples A to M we can understand, no problem. It should fit in somewhere. And therefore, what is that example say? It should have common management. Whether that company to whom you have sold the goods, is it under your management? Answer was no. Do you own any share capital of that company? Answer was no, not a single percentage. Do you control that enterprise? I said, sir, what do you mean by control? I don't have any control over that independent enterprise. I have sold the goods based on the negotiation. Though no doubt they were asking for a lower price and I gave it because I wanted to sell ultimately. So the tribunal took a view, you have no control. You are dependent. Now please understand. Simple example. There is a difference between dependent and control. You are dependent on somebody does not mean you are controlling their enterprise. Simple day-to-day example which I have quoted here. One of my juniors in my office told me, and he was a teenager. He says, sir, I am dependent on my father, but my father cannot control me. So how can you say that dependent and control is the same? I have a clue, I said, fantastic, what you said is correct. This is a day-to-day problem of every parent. We can't control our children. So if that is the case, there has to be difference between control and dependence. So therefore such companies are dependent upon raw material supply or franchising or sales, but they are not under the control. Since control conditions under 92A1 are not fulfilled, the associated enterprise relationship do not come into existence, transfer pricing provisions do not apply. And that is a correct analysis of the decision which is rendered by the Chennai Tribunal. Citation of course I have given, and that is in the case of Orchid Pharma Limited. 92. The instructions to me is be a little fast. Don't go into so much detail. Nobody is interested. They want to know more and more things. I said, okay, if that is the case, that's very easy for me. So therefore, if you look at conflict under the treaty and the domestic law is bound to be there. TP documentation and reporting consequences will arise. Secondary adjustment. Question is whether secondary adjustment has any penal consequences. EU report says secondary adjustment itself is a penalty. So therefore, don't have further penalty on the secondary adjustment. And OECD also recognizes this. But in India, we can't expect that to happen. So therefore, you have excellent future time for the professionals. Don't have to bother at all. Then, best practices example. If you look at UK practice, I have prepared for you the list of questions they had put to on the website for the public to view comments so that they can develop the law and come out with the explanation. Possibly the best solution I think was best solution in this circumstances. Last item I am taking, so I will go to the next item. Mr. Kapadia felt that OSWA does not have any material to speak, so that's why he is speaking only on secondary adjustment. So don't worry, I will speak on that. The only solution OECD ought to have thought is that they were preparing a document called as a multilateral instrument. And if the multilateral instrument, when the BEPS Action 14 were finalized at that time, what will be the shape of multilateral instrument was not known. And they took one more year to come out with the multilateral instrument. This year in November, last year in November 2016, they came out with what multilateral instrument will be. Possibly, if the secondary adjustment is part of the treaties, then they ought to have brought this into the multilateral instrument when 100 countries have agreed to sign multilateral instrument. And if you make an adjustment in one country, automatically corresponding adjustment in the other country would have been allowed and the taxpayer would have not had any problem. But now since you have not taken up this subject under multilateral instrument, this is bound to result double taxation, sometimes triple taxation also, and this is a major cause of concern. And the only solution which I could think, and then the treaties would have got overridden completely because multilateral instrument will sit on the top of the tax treaties. And to the extent issues are dealt with in multilateral instrument, the tax treaty will be of no use, multilateral instrument will be used, and remaining part of the treaty will become relevant, and therefore multilateral treaty was a correct practice they ought to have come with, and amendment should have been made in the multilateral instrument. Next amendment which I am now talking about is the thin capitalization. Again, my comments on thin capitalization would remain same. If somebody is funding at a very low interest, we need to borrow more and more money. Infrastructure industry, infrastructure companies need huge capital. We have excluded bank and insurance companies from the thin capitalization rules which have come up. Before knowing the rules, I am just explaining you this. Because in the process of explaining, if I forget something, it would not be good. But OECD, EU, World Bank recommended thin capitalization should be avoided in the case of infrastructure companies. Because if you need development of the country, you need a lot of money, and if you need a lot of money, whether money comes in by way of a liquidity, whether money comes in by way of a debt, how does it matter to you? And see to it that it, based on your regulation, and particularly ours is one country which is more regulated than other countries. We have stringent exchange control regulation. So far we have not brought the thin capitalization in the country because our Reserve Bank of India is controlling external commercial borrowings. They permit up to a particular percentage of capital. They now have been little relaxed on account of, but nevertheless the debt equity ratio is provided in those external loans, and therefore there is no purpose in getting thin capitalization. When do you borrow the money from your parent? When all your revenues or avenues of getting these borrowings at a lower rate of interest gets exhausted. There are no bankers are ready to fund you. You are in losses. Who will fund you? The parent company. And if the parent company funds you, they also have the transfer pricing regulation in their country. How can they fund you now free of interest? They have to charge some arm's length interest. Those parents are borrowing from the banks at a very nominal rate of interest because world is matured and developed, where fundings are available at a very cheap rate. And they take those loans and they give you back the loan to our country. And you say initially because you are a loss-making entity, your interest paid will be definitely more than 30% of the EBITDA. So obviously 100% will be disallowed. And therefore these are the draconian regulations in this country which we have got. So far, I have been discussing this subject every year with the Revenue Department, drafting the legislation. They say we don't consider it to be relevant and necessary for our country because our Reserve Bank of India controls the external borrowings. But this year is a fashion because we participated in G20 OECD discussion very extensively. We made the public in the OECD G20 MAT. We have thought number of suggestions we have given, but most of our suggestions were not accepted. And therefore, at least we thought that it is necessary to get into those suggestions here in this country, and we got the thin capitalization. What is this thin capitalization? They say, if you pay interest to your parent, then the deduction on account of this payment of interest should be restricted only up to 30% of EBITDA. Now, the interest is paid to associated enterprise. Sometimes the interest is also paid to third party. At times, the associated enterprise don't lend you the money, but they give you guarantee. That guarantee is given to the bank, telling the bank to please lend the money to the Indian subsidiary. They don't lend the money directly because exchange fluctuation, foreign exchange fluctuation risk also exists. So instead of involving themselves directly lending the money, they give guarantee to the bank, third party, and third party is told to lend the money to the Indian subsidiary. Now when we pay interest on the basis of such guarantees to third party, this is also deemed to be associated. This is also deemed to be treated as part of the interest paid to related party. Because it is based on the guarantees given to the related party. The guarantees given by the related party. And therefore, interest paid to your third party will be part of the total disallowance. That can lead to a number of consequences. What the law says, excess interest shall be disallowed. How to calculate excess interest? Look at the total interest you have paid. Total interest including interest paid to associated enterprise. Then compare that interest, calculate 30% of EBITDA. EBITDA means earnings before interest, tax, depreciation and amortization. As per your account. Now the question is, you are talking of accounting now or you are talking of income tax now. In income tax there is nothing like EBITDA. For the accounts we write only the EBITDA. We calculate and we show presentation accordingly. But for tax purposes, we do not rewrite the balance sheet. So therefore, this will be an issue by itself. So you calculate 30% of EBITDA, then compare that with interest paid to associated enterprise. Find out the difference between them. Lower of that will be allowed as a deduction. If interest paid to all the borrowings, including related parties, is say 1,000, and your EBITDA is say 5,000, or maybe 12,000, then 30% of that 3,600. Then interest paid to the related parties you consider. How much is the related party interest? Say it is 4,500. Then it is exceeding 3,600 and therefore the excess will be disallowed. And that will be, I have given number of calculations for the sake of understanding in the subsequent slides. So therefore, lender or a guarantor need not be associated enterprise. A third party guarantor also, third party lender also will be an associated enterprise for the purpose of this calculation. Bank and insurance companies are excluded. Now what the law says, the excess interest paid value will be disallowed. But we are merciful. We will allow that excess interest paid, since it is disallowed this year, in subsequent 8 years, if there is a profit. If you have got a profit in the subsequent year, we will allow you the reduction. Again, we will calculate interest, for the purpose of calculating interest paid to associated enterprise, this carried forward balance also should become part of that. Though law is not clear on that, but it is going to be part of it. And therefore, we will, based on the again revised calculations, subsequently we will reconsider the case. But in the infrastructure company, if the initial capital intensive companies, those profits are not expected to be in 4 or 5 years, then they will lose the chance of set off of such interest, and therefore it is going to create a lot of difficulties. As I said, it excludes bank and insurance companies. Such attempt was made by Income Tax Department in the past, disallowing interest on the basis of thin capitalization. But we have a decision of the Bombay High Court which says, in the case of Brexit care, the whole essay, no such thin capitalization rules exist in the country, and therefore no discounts can be made. Unfortunately, that decision of Bombay High Court gets overruled with this amendment having been brought under the law. The intention is to disallow interest payment to related parties. However, if you look at the associated enterprise definition, as we discussed earlier, is so wide, and every type of interest is covered by this particular definition. Now, while in the enthusiasm of defining this interest, whether interest should be calculated gross or net is also not clarified. My opinion, if you are comparing interest with the EBITDA, then consider the net interest, because you may have some interest income as well. So only the net income, and for some countries in the world which are following the thin capitalization rules, always consider net interest and not on a gross basis. And we have South Africa's example also considered it to be a net interest and not on a gross basis. When I said associated enterprise definition is so wide, any type of interest paid to any of the associated enterprises also will be covered, including late payment on account of purchase of raw material. Interest paid also can be part of such interest, and therefore that also will be calculated. Issue arises, if I have borrowed the money from related party for the purpose of capital expenditure and I have capitalized in the fixed assets, will it be disallowed? In my opinion, my humble submission, no, you cannot disallow unless you have a specific provision. This year in the budget itself you can see, if the cash payment is made for purchase or acquiring an asset, the interest will not be allowed to be capitalized. That provision has been made. There is no such provision which exists in the law, and therefore this also will not be applicable to interest. Capitalization will not be subject to thin capitalization rule. The issue is again here, the threshold is 1 crore. You must have a transaction of payment of interest in excess of 1 crore rupees. Then only these rules will apply. This is known as the de minimis rule. I fail to understand how can 1 crore be the limit, only small limit. The other countries have $1 million as an interest, £1 million and $1 million Australian dollar as a similar limit in their country. What is this thin capitalization rules are? If you look at, this is a positive correlation between the degree of interest deduction limitations